Right. Hello, everybody. Thank you very much for joining us. I know there are a few people still joining, but we will kick off. Welcome to our 5th economic update session with Investec. And it's a particularly timely one, although I think I said this every time. As well as an economic update today, we'll also hear about what's happening in UK venture capital. Very quickly before we start, I'm Sarah Turner, co-founder of Angel Academy. We're a network of angel investors, and we invest in female-founded startups and introduce more women to angel investing. We backed 45 businesses so far, all but one in tech or science. When we started in 2014, there were only a tiny number of women investing, and the networks I was part of didn't really deliver what I needed or what I thought other female investors in particular would need. So Angel Academy was created with women in mind to help close the gender investor gap, as well as the low levels investment going to female founders. Men are very welcome too, and make up 30% of our membership. Our value proposition for both investors and entrepreneurs is our depth of experience. We have reviewed several thousands of pitch decks and met thousands of founders over the years. We're very well organized and transparent as a network, and our members are either successful entrepreneurs themselves or senior leaders. And we're very proud to be ranked as one of Bohurst's most active angel networks in the UK, with the only female-focused network to appear on that ranking. Anyway, enough about us. Without further ado, I'd like to introduce our first speaker today. We're going to have 2 short presentations followed by Q&A. I have a few questions to kick things off, but please put your own questions for the panel in chat. First up is Sandra Horsfield for her regular economic update. Over to you, Sandra.
Hello, and thank you very much for introducing me, and welcome everybody. I thought I would just quickly share a few slides with you to summarize where we stand in terms of the economic outlook as it stands right now. To summarize, first of all, the main issue that the global economy is still facing at this point is, of course, that of inflation. We've talked about this in past updates, but it is still very much the case that inflation across the major developed countries is at multi-decade highs, and that forecasters really across the board have been surprised by the strength and the persistence of inflation. Multiple factors have come to play, and we've touched on these in the past. So supply chain disruptions around COVID were one of them, very tight labor markets were another, and of course now importantly the energy issues in particular as regards natural gas. Energy, though, is clearly not the only factor. I talked about this. In fact, the chart shows headline inflation, which is the price of everything, and that's the solid lines in the charts for UK, Eurozone, US. But core inflation has concerningly also moved far above targets. All these countries are really targeting 2% inflation rates, and we are a very long way from these at the moment, even if you strip out energy and food prices, which is the definition of core inflation. So that is really the key concern, and one the policymakers of the current generation haven't had to deal with for a very long time. How has the picture evolved? Well, the only of the major regions that has maybe seen the peak of inflation as yet, at least according to our forecasts, is the US. And even there, it's hardly the sort of inflation rate where victory can be declared quite yet. But we do think, on the other hand, that we may be approaching this level very shortly, perhaps in the Eurozone and in the UK as well. Of course, forecasts at this point are very much dependent on how the economy evolves. And for the time being, we've had these series of shocks which have consistently surprised to the upside. Now, just to turn to the energy issue in particular, it's worth noting that there are several dimensions to the gas price shock in particular, and to the challenges this causes. And different countries are really in quite different positions in grappling with these. There are two questions to ask. First of all, how much gas is actually used in primary energy consumption in each country? And that's shown along the x-axis of this chart. So clearly, the major gas producers, such as the Middle East and Russia, unsurprisingly use a lot of gas themselves in generating electricity. But Europe is not that far behind. Quite a lot of gas is used, whereas if you look at India and China, much less gas is used. So a surge in gas prices is less of an issue simply because they use less. The second dimension, though, is how much of that gas is domestically sourced and how much comes from the rest of the world. And that's really the energy security dimension, which has very much come into focus in Europe. And unfortunately, on that dimension, Europe is particularly poorly placed. So a lot of gas is imported, and quite a lot of gas is consumed in the domestic energy mix. So on both fronts, Europe is in a particularly challenging place, whereas places like India and China have quite a different level of exposure to gas prices. And indeed, not only the Middle East and Russia as gas exporters don't have net energy dependency, but the US, quite interestingly, is in a different boat too. The US as a country is a net exporter of gas. So it actually, on the whole, it is a beneficiary as a country, not on an individual level, certainly not at a consumer level, but as a country, the US benefits from rising gas prices. So this challenge really is quite different depending on where you look. How have countries, especially in Europe, responded to this? Well, clearly fiscal policy has been a very major part of this. And the situation is quite nuanced depending on where you look. And certainly the UK experience has been a particularly special one over the last few weeks, to put it mildly. Of course, we had a change of government with the Truss administration putting forward what was termed a mini budget, but was actually the largest fiscal event in 50 years in the UK, involving a lot of unfunded tax cuts being proposed. And that came despite the high inflation environment that we talked about, and despite the fact that unemployment is very low. So that clearly sent yields surging. And it wasn't just the sort of proposals that were being put forward, but they also came alongside some threats to the institutional framework. Some questions whether the Bank of England should stay independent were sort of hinted at in the leadership race. And all of that, the lack of scrutiny on exactly the fiscal plans from an official body such as the OBR caused a big panic in market, which culminated and was brought under control by intervention from the Bank of England, but then of course prompted several U-turns and indeed a change not only of Chancellor but of Prime Minister, as a result of which the sort of major panic in terms of the interest rate market seems to have been resolved for now, but certainly it has come at a clear cost. And the lesson doesn't just apply to the UK, the lesson is quite clear. The room for fiscal expansion at this point is limited, and maintaining credibility at all times is absolutely essential and not something that you can take for granted, because the judgment of markets is one that follows imminently and has big potential long-term repercussions. A further issue to take into account this year has been the context of dollar strength. Now, this chart here shows just from the UK perspective how sterling has developed. And it shows sterling year-to-date changes against in trade-weighted terms. So that's sterling against all other currencies. And that's the dark blue line. But then it strips out the impact of just its move against the dollar and the move against all other currencies. And you can see that the move against the dollar was absolutely phenomenal this year. Sterling has lost a lot of ground against our other currencies and much less ground even at the peak against currencies that are not the US dollar. That same picture could be drawn for the Eurozone, indeed for the rest of the world. And partly that is indeed because the US is a terms of trade beneficiary. So it is benefiting from higher gas prices, as well as, of course, from interest rate differentials, where the Fed has been particularly aggressive early on in the tightening cycle relative to the other central banks, and that supported the currency as well. That, of course, has again amplified the inflation pressures that the UK is experiencing, that indeed all countries other than the US are experiencing as well, and made the problem of dealing with this so much bigger. Now, how have central banks responded? Well, we all know that there have been a series of rate hikes, have been very aggressive rate hikes. It has to be said, in the UK, we may be about to have our first 75 basis point rate hike at the meeting tomorrow. We shall see. That's certainly what we expect and what is priced in. But we've had a lot of rate hikes already elsewhere, and further rate hikes seem likely to come to indeed bring price pressures back under control. Now, what can central banks bring under control? Certainly not energy prices. That's outside their scope of what they can influence. But the idea is to generate spare capacity, especially in the labor market, because if wage demands are constrained, then core inflation, which I had shown early on, could fall. And if energy prices even just stabilize, that should mean that inflation in itself could come down. We think that given the sort of limited fiscal support that we're getting, indeed the fiscal tightening that we're getting in the UK, the likelihood is that we'll get this loosening in the labor market, we will get recessions, and as a result, there isn't the need to go quite as far as the market is pricing in terms of interest rate hikes. Where do we end up on the growth side? Just to summarize, well, our view is that indeed recessions do now look likely. The key factor in Europe, apart from the terms of trade effect of higher energy prices, which households and firms will have to shoulder to a certain extent, despite some government help, are interest rate rises. We've seen very steep interest rate rises by central banks. We've seen yields, longer term yields moving higher as well. All of these, of course, are funding costs for corporates. And as a result of all of this, we're likely to look at a period of contracting activity as we head into next year. Now, the good news is that we don't think it will be a very steep downturn, and for a couple of main reasons. One of which is during the pandemic, households had built up a lot of savings, and that stands to limit the degree of downturn if consumers can dip into those and keep up spending through that. A further effect, of course, is that with energy efficiency measures, with energy transition measures necessitated to enhance energy security, all of that is investment as well. And that sort of investment spending that will happen irrespective of where interest rates are stands to limit the degree of the downturn that we will get. So overall, only a fairly mild recession, importantly also helped by the financial system, which appears in reasonable shape this time around, and indeed is benefiting from higher interest rates in aggregate than we had in the previous Euro crisis, global financial crisis, where there were very clear elements of stress in the financial system and which exacerbated the degree of downturn. So not a calamity, but recessions, unfortunately, do look likely across the major regions by 2023. That's it.
Thank you very much, Sandra. Now I'm going to invite Izzy and Ollie to the stage from the private fundraising team at Investec. So they're speaking to VCs most days, I imagine, and are going to share their insights. So what's going on?
Thanks, Sarah. Hi, guys. As a brief intro, I'm Izzy. and I've got Ollie on the line as well. He's just about to kindly share the slides for us, so just bear with us. But as a brief introduction, so we both work in the private company fundraising team here at Investec. So we're advising earlier stage businesses that are raising growth capital. So we typically advise across the spectrum, so anywhere from a sort of roughly £10 million sort of smaller Series A round, all the way through to larger £100 million plus pre-IPO rounds. But we typically spend most of our time working with companies that are raising their probably C or D rounds, but we do get exposure to companies at other stages of their life cycle as well. So yeah, it's definitely been an interesting time recently, helping our clients to navigate the current market for funding. So we'll talk to you a bit more about that today in terms of what we're seeing both from the company's perspective, but also from investors' perspectives as well. And then we'll give a bit of an update more broadly on the market for fundraising and what key themes we're seeing. So as you can see, a market boom in VC has been going on for about 10 years now, which peaked in 2021, which was a mega year for deal value in the UK and also globally. This boom has been driven by a prolonged period of low interest rates, where investors were flocking into venture capital as they sought returns and were willing to accept high risk as a result. And then alongside this, we saw a number of large hedge funds like SoftBanks and the Tiger Globals of the world come in and sort of rock the traditional diligent VC approach and introduced a high velocity deployment model into the venture market. So these funds were deploying capital with limited DD at high valuations and deployed a lot, which was sort of key to their strategy. And so this led to an environment of highly competitive funding rounds, accelerating valuations. But despite the sort of more gloomy headlines about the state of private markets and the correction in valuations that we're seeing sort of across the board, we are still seeing very strong levels of activity this year. So in terms of deal activity so far, the UK actually saw its strongest opening half on record, with deal value up 16% versus the first half of 2021. And 2021, as I said, was a record year itself, with deal value doubling in the UK. So overall, it felt like a very promising start to the year. But even though the start of the year was strong, we have seen a drop in deal volume and valuations in the UK as the market outlook is changing, as Sandra just commented on. So it's definitely become a more challenging market to raise funds in, and it's a tougher market for entrepreneurs. So as you can see, deal value in Q3 is down, and it's down by nearly 60% year on year, illustrating the nervousness that's creeping into the venture market ahead of a more broad economic downturn. And so as well as reduced deal value and volume, we're also seeing company valuations come down. So we've started to see some quite prolific down rounds in the market, so where a company has to raise a lower valuation than its last round. I think Klarna is probably the most notable of that, which had to accept an 85% drop in its valuation from $7 billion, dropped to $7 billion from its $45 billion high a year before. So as companies try and avoid down rounds, which can be perceived badly in the market, we're starting to see more extension rounds and convertible loan notes being raised instead of new equity rounds. But overall, venture has proven to be quite resilient, particularly versus the IPO market, which has remained very shut with no clear view on when that will open. And so as a result, we're seeing quite a lot of potential IPOs flip into private funding rounds too, which has sort of helped to buoy the market in H1 as well. But private market trends are often led by the public markets, and so obviously they're down substantially year to date, particularly in terms of technology. And so tech actually saw, I think 800 billion was wiped off tech stocks last week alone, which is sort of illustrative of the problem. And we're definitely starting to see that feed through into the private markets. So our next slide, this sort of explains what we call the VC flywheel, and it kind of explains how we've ended up with such hype in the VC market and also such impressive growth in the volume of deal activity. And so as you can see, it's quite self-fulfilling in nature. And so there's a strong correlation between the growth of VC-backed companies and also then the capital available to them. So when times are good, businesses are raising lots of capital, they're then investing in their growth and growing fast. And so then as a result, they can raise like quite competitive rounds at accelerated valuations. Then at the same time, the VC funds that invested into those companies have strong fund performance. So more LP sort of inflows go into the market, And then these funds have more to deploy, so then they can continue to participate in these rounds going forward. So yeah, it kind of is a bit self-fulfilling and goes between the two. And so I mentioned earlier those sort of crossover hedge funds that have started they were deploying heavily into the private markets. They've actually sustained some fairly large losses from their public positions at the start of the year. So Tiger's flagship fund ended H1 50% down after fees. And so this is sort of adding more nervousness into the market. And we're already starting to see these flywheels reverse a little bit. So they kind of work in the same way in a downturn as they do in accelerating a boom as well. But at the end of the day, we do feel that there is the capital in the system to invest. Do you want to go to the next slide? Thank you. So even as the downturn means that more investors are sort of probably trying to focus a bit more on their portfolio, which might be struggling, and this can take up their time and bandwidth, these funds do still have the capital to deploy. So 2021 was not only a record year for deal value, but also for VC fundraising. And this is again continuing into this year. So 12 billion euros has already been raised in Europe so far in the first half of this year. And so we pulled out a few select examples of recent fund activity. And as you can see, there's sort of some huge funds being raised, like EQT's 2.4 billion. Let me go back. Oh, sorry, I think the slide's a bit stuck. So EQT was an example of one which raised 2.4 billion in September. And then Sonova was another one we wanted to pull out because so they're a more traditional PE fund, but they actually allocated 300 million of that fund to go towards earlier stage growth opportunities. So it's kind of showing that actually there is still the market for growth in VC in the market for sure. But in the current landscape, it is more challenging for businesses to raise funds, particularly as uncertainty rises and the fear of economic downturn increases. So as a result, we've seen that the institutional investors are really tightening their investment process. So due diligence processes are becoming quite a lot longer and more detailed. So the fundraising process in itself can take a lot longer and is a bit more laborious for founders. So for example, we were working on a transaction recently where the investor spent over £1 million on due diligence fees for a funding round that was worth less than £25 million in itself. So that's just sort of indicative of where it's going in the market. And then alongside this, investors are providing more aggressive terms to founders to give themselves more downside protection and to reduce their risk. So we're seeing deals that are becoming a lot more structured with more frequent demands from investors for anti-dilution rights, higher liquidation preferences. And this is definitely something that we think sort of seed and angel investors should be thinking about also. And yeah, so I think today investors are far less concerned about the valuations, but actually more on guaranteeing their returns. So they're kind of using structuring to do this. And then alongside this, there's definitely considerably more focus on companies that can demonstrate a credible path to profitability. So previously, as I mentioned in that flywheel slide, growth was valued, previously was valued the most highly and was sort of the North Star metric for most VC-backed companies. So there was less investor concern about efficiency and self-sufficiency, and this led to a pursuit of growth at all costs. But we're definitely seeing this change in the mindset of nearly every investor that we're speaking to, who wants to see companies that can demonstrate capital efficiency, especially if follow-on funding might be more scarce. And we actually saw some analysis recently by a growth investor called Iconic that did some analysis on listed tech stocks, and it just showed a massive increase in correlation with valuation and profitability and less correlation with valuation and growth. And so that is definitely what we're seeing in the private markets as well. And then finally, there's just been general multiple compression. So valuations are coming down across the market. And this has been seen across all equities, and that's now rippling through to private markets too. However, we do feel that market downturns can create an opportunity for investors to participate at lower multiples. And we're seeing a lot of investors that feel this is actually a good opportunity to shake out some of the hype in the system and bring prices back down to earth a bit. So for the right businesses, the private capital definitely remains, which leads us nicely onto what we're seeing on the company side as well, and sort of how investors should be thinking about potential investments. So fundraising will not be easy in the months ahead. So before seeking new funding, we're seeing founders focus on some of the core metrics on this slide to ensure that they're best positioned. And we actually saw, so a number of sort of leading global VCs have published documents as well, guiding their portfolio on how to manage this downturn. And these are some of the key themes that are prevalent, as well as what investors we're speaking to have been looking out for as well. So there's quite a few examples here. So I'll just pick out a couple, but we'd be happy to discuss any of the other ones afterwards. So they're kind of broadly split into buckets of efficiency and quality of earnings metrics. But I think a disciplined approach is more important than ever, and runway and cash burn need sort of laser focus in a market where following funding is scarce. So businesses able to develop to demonstrate good capital efficiency and a strong path to profitability is key. And then, sorry, 1 second. I've got a bit of a cold. And so yeah, the rule of 40, which is on the right-hand side. So the right-hand side, sorry, just shows some more specific SaaS metrics that we wanted to draw out. So the rule of 40 is measuring growth and profitability together in tandem. And so the general rule of thumb is that a SaaS company's combined year-on-year growth and free cash flow margin should together meet or exceed 40%. And then, yeah, the ARR per FTE, so that's recurring revenue per full-time employee, helps to measure like employee productivity. And then on the final side, we're running out of time, so might not have time to touch on this in too much detail. But these are kind of a few sort of sector areas that we're seeing VCs favor at the moment in the context of the current economic landscape. So as angel investors, it's probably worth considering some of these, as we're seeing a lot of VC dollars flow into these areas. But overall, it's sort of those that are mission critical, so providing essential services are being favored, as well as those that are tackling themes that are really prevalent in this current market. So for example, within fintech, money saving tools is sort of becoming a really interesting subsector. And then we also saw last week that Facebook and Alphabet both had big misses on their ad revenue. So I think business models that depend on ad revenue going forward will probably find it tougher to raise capital in this market. So yeah, hopefully that was a helpful insight into the world of VC, and please let us know if you have any questions.
Thank you very much. That was very helpful. And are you happy for us to share your slides if anyone requests those?
Yeah, of course, please do.
Okay, thank you. So please let us know if you'd like a copy of the slide. So if everyone wants to turn their cameras on now and join me for the panel session, and I'm just going to invite attendees to submit their questions via chat, but I'm going to kick off with a few. Do you want to come back on screen, Izzy and Ollie? We'll get you.
Ollie,
so first,
having a few camera issues.
Okay, we won't wait for him then. So starting with you, Sandra, thank you very much for the analysis. That was really helpful. How confident can we be that inflation will start to fall, and what will drive that as well?
Yeah, these are very good questions. I think on the confidence side, as a forecaster, we need to be quite humble at this point. We have had upsides, surprises on inflation for a long time in a row, and it hasn't just been us, it has been pretty much every forecaster you want to look at, whether it's central banks, official institutions, and not just in one jurisdiction, but another. The reason why we had this pickup as inflation, as I said, had several elements and sort of a series of shocks that have come and compounded one another. So I think the reason why we think, and we are reasonably hopeful that inflation will indeed come down, is that some of these things are starting to improve. So step one, for instance, COVID disruptions. We had a period of time when demand for goods had outstripped the capacity of economies to produce, and especially to distribute and deliver. We had disruptions in shipping, soaring shipping costs, and just simply COVID lockdowns causing issues. These have started to be resolved, and indeed shipping costs have come down quite a long way already, Europe. So some of these sort of factors that had put some sand in the grid of the wheels, if you like, in the global economy are starting to improve. Step two of this, the energy part. Now, obviously, the energy shock was and is very clearly related to the war in Ukraine. What is happening with energy prices is very hard to predict. But what is important to bear in mind is inflation is the change in prices relative to a year ago. And so if prices just stabilize, so they don't even have to decline, they just have to stay where they are, a year from now, we'll end up with zero energy price inflation. So even if prices don't come down, after a while, the inflation rate should come down unless they keep on rising and keep on rising at the same rate as we've seen already. We've had incredible increases, and now it's the dependency on Russian gas, etc., has diminished. So it's not so clear that there will be quite the same sort of rate of increase or even any larger increase. Now, there's still some filtering through electricity chains, etc., to go on, but the pressures should diminish on that side. What is less clear is the part that relates to the labor market. For now, it hasn't been the case that labor markets have loosened. So this is a forecast that all central banks are very much hoping they will achieve this loosening in the labor market, because arguably they went too far and kept rates too low for too long going into this crisis. With recession, though, we think that should turn, and that's sort of the third factor. That's still the key missing ingredient.
Thank you. And then another question for you. So most of the measures in the mini budget have been dropped, as we all know, but why do we still need fiscal tightening then?
I think there are a couple of factors that have changed. So first of all, when the last set of official numbers were put together in the last proper budget in March, the economic outlook was very different. The war in Ukraine had barely started. We didn't have the sort of energy price measures and changes then. We didn't have the need for such huge fiscal support for energy that is still coming. And that has to be paid for in some form or other. That's part one. Part two, the interest rate picture has changed dramatically. And we have to remember that interest rates also means that the cost to the governments of servicing the debt that they have has increased. So in the UK, it's about 20% or so of the stock of government debt is index linked. So that means as inflation rises, the government has to pay out more money to service that debt, and that is expensive. So higher inflation, unfortunately, means more government spending on paying interest rate debts. So that's another reason why this has changed.
Okay, thank you. So Izzy and Ollie, what do you see as the main opportunities within the VC market in the current environment, both for startups and for us as angel investors?
I think sort of one of the key opportunities that we're seeing is that, as we mentioned, valuations are coming down. So actually it's actually a really good time to be investing in earlier stage businesses. So yeah, I think there's a lot of opportunities on that side in order to just come in at lower multiples than what we've been seeing over the last sort of year or so. And additionally, some of the bigger sort of VC-backed or growth-backed companies where their cash burn is quite high, they're having to lay off a lot of people, which I'm sure you will have seen in the news. So there's actually more tech talent available than ever. And so actually for the entrepreneurs that are in a position where they can sort of be a bit more defensive, those that can be agile and sort of beat competition in this environment can also actually grow their teams quite well with experienced people who are looking for jobs in the tech space at the moment.
Okay, and just kind of following up from that, you mentioned some sort of sectors that would be quite attractive at the moment. One of them was mission critical. Can you give some examples of mission critical businesses?
Yeah, so to take a couple of transactions that we've worked on over the last 12 months. One was providing basic core banking technology. It's a fintech that you know that well. but the technology that it sells now sells into Investec and into HSBC as examples. So that's sort of 5-year contracts, and if either of those banks, definitely Investec, pulled it out short notice, they would fail to serve sort of thousands of customers. So that where it's not a discretionary spend by the company is a good example of mission critical.
Yeah, so I think it's not necessarily a sector as such, but it's more a descriptor for businesses that are selling something that just is essential for other businesses to function effectively. So it means that the customers are very sticky, and it gives them a bit more control in an environment where obviously there's margin squeezes, etc., going on.
Right, okay, that's clear. And then similar question around money saving tools that's come in from one of our audience members, and they're saying, really, is there more room in the market? There are so many of these out there already, or are we missing something?
I suppose it's probably worth noting that fintech's been battered pretty badly by the sort of tech markets at the moment. But I think one thing that we always think about is that the TAM, the addressable market for these fintechs is huge in general. There's a lot of fragmentation, so there's definitely some opportunities for sort of consolidation / aggregated players to come in and sort of help rebundle people's financial lives. But I just think that in the current market, though, more fintechs that are focusing on that kind of money saving, budgeting sort of angle of fintech is probably quite interesting, versus other more discretionary fintech subsectors.
I'd say the shift that we're seeing is, so, money supermarkets have done very well, but it's relatively legacy technology compared to some of the more automated applications that are out there. So came across Plum quite recently. A lot of those around how you budget and you make these decisions in a much more automated manner rather than
scope for disruptors to the disruptors. Next generation of disruptors, right? Okay, thank you. And how are term sheets evolving as well? You mentioned change in valuations and more structuring of preference shares and different share classes. Can you tell us a little bit more about that?
Of course. So I think we're starting to generally see a few more sort of more predatory type term sheets come through, which basically just means that the control is more swinging in the favor of investors versus the founders. So I think during tech boom times, term sheets are typically a bit more skewed towards giving control and incentives to the founders. So it's more that we're just seeing this be a bit reversed as investors are seeking more downside protection. So overall, I think from an investor perspective anyway, it's a good thing, but it's just something to be aware of, as I suppose if you've come in earlier, you don't necessarily want to get caught up by people having way better terms than you later down the line. So just making sure that you as angel investors are sort of getting these just the basic terms in upfront, and protections to make sure that you're at least sort of one rung above the founder in terms of on the sort of liquidation preference stack.
Yeah. So we can do that as EIS investors mainly. We can do that on the liquidation preference. It's a bit difficult to invest in anything other than ordinary shares though, and remain qualifying for EIS. But yeah, something to watch out for from the people that we invest alongside. Okay, question from Jodie, who's one of our investors. Can we expect a longer path to exit these days, given the extra extension rounds, slower due diligence, fewer IPOs, etc.?
I think it's going to be quite interesting the next year. There's a lot of PE who have raised very large funds, who are looking for more profitable businesses. If some businesses that historically, I guess, chose to raise significant rounds all the way to sort of Series E, pre-IPO rounds, and kind of push their growth until the point that they IPO'd. We think those types of businesses are less likely to exist now, and businesses that are more focused on reaching profitability and becoming more attractive as either a bolt-on for a larger corporate or to be bought out by a majority PE in a more LBO type transaction. Those events can actually mean that you get your secondary sale of your shares a shorter time period, multiple rounds on the way up to an IPO. So it really depends how the M&A market, which is a bit nervous at the moment, but we think next year, and there's a lot of things online that suggest next year that market could get quite busy. Definitely fewer IPOs and slow DD periods, both of those are things that we're seeing. So it just depends on the type of exit, I think, that's available really.
Okay, and will that lead to smaller exits, do you think, or?
It could.
We don't know yet. Yeah.
It could lead to smaller exits. I guess the question that a lot of people are saying is, for early stage investors, does that matter too much if the entry multiple is lower as well? Because it's a point to point. Obviously, it's how you make your return. So if multiples come down on the way in as well, then it could still be beneficial.
Okay. And are you seeing any variation in terms of sort of resilience between different pools of capital? So is there a difference between hedge funds and private equity and venture capital and seed stage funding?
Yeah. We'd say that most listed funds, so most hedge funds have a listed element, have struggled the most because they have redemptions, they're not in fixed fund cycles. We're seeing a lot of activity from sovereign wealth funds and family office, actually, that are backed by oil and gas money for obvious reasons. So a lot of activity from the large Middle Eastern sovereign wealth funds still. PIF, the Saudi one, for instance, has been pretty vocal over the last week or so about its investment ambitions. At the sort of smaller end of the spectrum, we feel a lot of people have done quite well through the current cycle, and have made money in technology and through tech exits. And those individuals tend to be keen to continue to deploy in that market, regardless of whether or not they can get an extra few percent on their on a debt product. They find it more interesting, and if they've made enough wealth that they're sort of personally comfortable regardless, we feel that there's still a lot of money available at that end of the spectrum.
Yeah, and those of us who've been around for a while, I keep saying this, we've lived through various cycles, and cycles come to an end, and especially if we're investing early, it's in a, there isn't going to be exit until we're well into another cycle or the one after that. So
I think there's a lot of information online about the best performing VC and PE funds. They were the vintages that were raised in the year or two after the last financial crisis. So if you start investing next year and the year afterwards at the kind of bottom bit of the cycle, obviously the idea is you exit towards the top end of the cycle, assuming that they are on average 10 plus years cycles.
And then I just wanted to ask you a question specifically about pre-seed and seed stage funding, because that's where we play, at least in the initial rounds. And that had already declined as an amount of money going into these businesses well before this year. I think Atomico said that decline of 50% between 2016 and 2021. So those early funding rounds have always been tough. So does this mean that angels are needed more than ever? We've got to hold steady and create the pipeline for those later stage investors that are still investing. What's your view on that?
Definitely the case, but I think it's also good to remember that actually economic downturns are often a really good time for people to start to create a business. If people have maybe been laid off for whatever reason, it's that kind of could be the push for them to start the business that they've always wanted to. And so actually we tend to see that there's quite a lot of entrepreneurial activity at this point. And actually history shows that great companies form and grow regardless of market cycles. And a lot of the sort of best companies that are out there, like the Airbnbs and stuff, have been founded in economic downturns.
Absolutely, yeah.
So I think there's definitely opportunity, and of course, those sort of funders at the bottom end of the cycle or of the spectrum is really important in order to help those businesses get to the point where they can then start raising the bigger funding rounds later down the line.
It's clearly, although there has been a lot of chopping and changing from the government over what they do consider to be a priority. It feels like it is a priority, and obviously was raised in the mini budget in terms of sort of increasing the VCT tax relief, and the number of years actually of businesses that have been operating. So we obviously in our world want to see as many good quality startups be established at that seed stage, and then to come through to scale. And I think, as we probably all know, this is slightly a volume game. So
yeah,
capital coming in at those early stages to stand a decent chance of producing better businesses later on down the line. So, but you know, as with everything, I think it is just trying to pick those winners and to focus in, kind of what we tried to do towards the end of the presentation, on businesses which are likely to be attractive to investors later on down the line, because ultimately those good quality assets will attract strong valuation still.
Okay, thank you. And then sort of, you know, standing back, bigger picture, perhaps bring Sandra back in as well. House prices, and are those going to fall, and will that affect, I mean, you know, that tends to affect individuals investing, but what's your view on house prices?
Yeah, I mean, house prices are, again, have several dimensions to this. Certainly at much higher interest rates, and it's not just the sort of base rates, because now most people are in the UK are on fixed rate mortgages, which, however, are relatively short fixes. So we have a large number of people who are due to reach the end of those fixes in the course of the next year. And if you they have to refinance, that will be at substantially higher interest rates than we've had beforehand, which is clearly something that is already being reflected in sort of transaction volumes. Buyer inquiries, etc., have started to slow according to the first surveys. House prices themselves, slightly. I think one thing to bear in mind is that in an environment where prices in general are rising quite steeply, the nominal house price may not actually decline that much, because it's house prices relative to the prices of everything else that matters. So you may, sort of rough thinking on our part is perhaps we could see a 5% or so fall in aggregate house prices in the UK next year. It's not a very big number, but if you consider that the price of everything else, so inflation, is still positive, that makes the picture quite different than if you were operating in a much lower inflation environment to begin with, in which case you would get a bigger nominal house price falls. So it's a complicated picture. Certainly interest rates aren't helping. What is helping, though, is that the labour market for the time being is still very strong and very solid. So that is still a source of income with which to service the mortgage debt for a large part of the housing market. Vacancies are still strong. So unless and until that turns, and it depends how much it turns, the picture doesn't look too bad to us.
And I think, at least in central London as well, prices will remain resilient, because you probably have some foreign buyers who are taking advantage of the cheap pound currently, and that might be the case in investment as well. I, you know, see overseas investors showing more interest in our market because everything's even more of a bargain, isn't it, with the exchange rates?
Yeah, certainly we have heard that from a number of sources, that indeed interest in UK PLC in the wider sense has increased as a result of the pound, and that's a factor that's for the time being still seems to be in place.
And just another question from our audience for you, Sandra, about implications of general political instability. I'm thinking that means that, you know, the UK is not the only unstable country in the world. It's we seem to be in a global mess, don't we? And how do you see that playing out?
There are lots of moving parts here, and I think we are dealing with a situation where most of the world is, I talked about terms of trade shocks in Europe specifically. the question, harsh though it is how do you allocate the pain that just comes from a country having a higher import bill between the various sectors? Who is made to pay? Is it taxpayers now? Is it taxpayers of the future? Is it companies? Is it households? Where do you split it? There's no good solution. It's what is the politically least unpalatable choice, and that answer differs according to countries, but clearly they're losers. And in this environment, it's sort of a certain amount of political instability is a natural side effect of that, if you like. In other parts of the world, I mean, we have US midterm elections coming up shortly, so we'll see what that brings. But certainly the potential for sort of moving forward with policies depends on whether we manage to overcome the sort of paralysis that comes if the House and the Senate are yet again very split. And for the time being, perhaps we wouldn't get a lot of big spending decisions being sanctioned anymore, but we shall see very shortly what comes out of that.
Okay, so I think now it'd just be good to get kind of one sentence summing things up for you, trying to sort of end this on a reasonably positive note, despite the challenging times. My personal takeaway is that we should be cautious at the moment, but not fearful. Now isn't the time to give up on investing. There are good bargains out there. How about you, Sandra? What's your final analysis here?
Well, as economists, we tend to think of creative destruction. And that's something that in the bottom, sort of in a period of turmoil, there are always opportunities that come about. And that's really what they're trying to capture. So there are those opportunities out there. We're not looking at a very deep recession going forward because of certain support factors. And certainly there are likely to be opportunities that are here to stay and resilient even in a higher interest rate environment.
Fantastic. Izzy, Ollie, over to you guys.
I think from our side, just the entire essence of venture capital is that you're investing on longer term horizons and investing into sort of paradigm shifting companies. So if you're able to do that at a discount during downturns, you're going to be able to massively accelerate your returns. But obviously, having said that, it is going to be more challenging. So be conscious of the fact that any potential investments might struggle to raise follow-on funding. So be really analysing their efficiency and abilities to actually generate profits and make sure that their business models are making sense and that you can see a path to monetization. But if all those things are aligning, this feels like a really good time to be investing in and sort of trying to accelerate returns if you're backing the right companies.
Great. Ollie, anything to add on that?
No, I just think that point around the last financial recession, with so many large companies and also excellent financial returns for those who invested wisely. But do watch companies' burn ratios, because I think with rising costs and kind of previously founders having assurance that they would be able to raise pretty quickly after their last round, that's probably the biggest risk to businesses is that short-term cash flow.
Right, I've just sorry, I've just seen a couple of questions in Q&A which I haven't been looking. I think we've covered those. Right, okay, well look, thank you very much. That's been a really good discussion. I will share the slides with anyone who requests them. That's okay with you, so please let us know if you want the slides. If you put something in chat, Michelle will take notes. She's on our attendees as well. Just before we go, Simon, can you just bring up my last slides? We've got some next steps to run through for people who are new to Angel Academy. If you wanted to talk to anyone at Investec, Hannah Goody is our main contact there, so her email address is on screen now. Please, if you're not already investing with us, but you're interested in angel investing, join us as an angel. If you're an entrepreneur and you're looking to raise funding, then please apply online to pitch to our angels. And if you haven't already, please follow us on LinkedIn, Substack, and YouTube. and also our website is on the bottom right hand corner. So thank you everyone for joining us. I hope you enjoy the rest of your evening. Many thanks once again to Sandra, Izzy and Ollie for their really fascinating insights, and I will see everyone again next time. Thanks very much.